Welcome to our Taking Stock video for the week ending the 27th of October 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share markets. Welcome, Matt. How are you today?
I'm very well, thanks, Kien, and thanks for having me again.
Great to have you on board, Matt. But before we get started, a quick yet important reminder: the information we provide during this episode is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any performance tables shouldn't be relied upon as a guide for future performance. Well, Matt, it's been a busy week for share markets. Plenty of volatility with the AGM season here in Australia, but also in the US, there was very strong third quarter GDP numbers. Furthermore, we had the September quarter inflation figures released, suggesting that the core CPI rose by 1.2% for the quarter, and this takes the annual core inflation rate to 5.2%, above market expectations and well above the RBA's target band of between 2 and 3%. And you might be thinking that this was due to elevated oil prices, but the core inflation rate actually strips out volatile items like petrol and food. More worryingly, though, services inflation remains elevated at 5.8%, and this was driven by higher wages and rents.
Yeah, it's a concerning set of numbers, isn't it, Kien? And Michelle Bullock's obviously got some thinking to do ahead of the rate decision on Cup Day, but the market is now pricing a 70% chance of a rate rise on this day, and this has put further pressure on interest-sensitive sectors like tech and property trusts. But once again, we want to reiterate the importance of separating the facts and the macro from the fundamentals. There are many high-quality growth and income stocks that have been sold down on interest rate fears alone, but many of these companies have strong fundamentals. What we're looking for are companies with competitive advantage that have high profit margins and solid defensive cash flows. But this is a shifting cycle, and over the short term, we do expect volatility to continue, and thus we have implemented a tactical defensive strategy for all of our managed fund products, whereby our investors are protected from downside volatility in all of this economic uncertainty.
Yes, Matt, that strategy has certainly protected the portfolio from downside risks over the last month or two. But in the current environment of higher interest rates, financially weak businesses are especially vulnerable. Take, for instance, this week we had cloud-based network infrastructure business Megaport. They dropped by 20% after releasing a softer than expected first quarter update. The company does have a compelling investment thesis, providing businesses with the security of connecting their data to the cloud without the use of the public internet. Not surprisingly, it is popular with 13 brokers covering the stock, and although the outlook appears promising, for us it's still too early to invest in this business, given that its financial health is in early warning.
Yeah, that it is, Kien. And speaking about quarterlies, this week the lithium miners released an update to their operations, and overall it was fairly mixed, with star growth stock Alchem showing better performance at its Australian project, whilst Pilbara Minerals experienced periodic shutdown for maintenance and construction. But the market reaction was fairly muted on this news, with investors already factoring in a weak first quarter 24 result following their early release of shipping data from the port. And in addition to that, Pilbara kept its FY24 guidance unchanged, expecting operations to improve from here.
Yeah, but I notice also, Matt, you've got to be mindful that there is a rise in short interest on the stock, which is now close to 15%. And that appears as Pilbara is shorted as a proxy for lithium prices. For those who are concerned here, though, and have any questions, please contact our resources analyst, Dan Ortiz, who'll help provide some insights into this.
Yeah, he's a wonderful resource, isn't he, Dan? And he's very, very close to these lithium stocks. So do ensure that you get on the phone and give him a call. But among other positive news this week, in its trading update, salary packaging and fleet management firm Macmillan Shakespeare pointed to continued strong performance from the salary packaging and novated lease segment, which reported some 29% revenue growth over the first quarter.
If you can recall, there were concerns around a slowdown of electric vehicle sales, which was the primary driver of the share price sell down post its financial year 23 result. So investors were quite happy to observe that there were strong electric vehicle sales momentum, which contributed to 36% of new novated lease sales over the quarter versus around 20% in financial year 23.
And from an income perspective, some investors may have noticed a drop in free cash flow in FY24 relative to FY23, but this figure is impacted by Macmillan Shakespeare's own securitization warehouse, which is essentially, it operates like their own debt facility where they aim to internally fund up to 20% of novated lease volumes going forward. So given the company's revenue structure, we continue to believe the dividend gross yield at around 10% is both attractive and the dividend we believe is quite sustainable.
Yeah, that is quite an attractive dividend there, Matt. And another company to surprise investors on the upside was outdoor and auto parts retailer Star Growth Stock Super Retail. Despite rising interest rates, the company reported like-for-like sales growth of around 2% for the first 16 weeks of financial year 24. And this reinforces our preference in having exposure to those diversified, high-quality retailers. Its super cheap auto segment has continued to benefit from value-conscious consumers taking auto maintenance in their own hands. Meanwhile, you have the BCF segment, the boats, camping and fishing. They tend to target a much older demographic, which are less sensitive to mortgage debt and interest rates. Hence, we believe that gross dividend yield at around 7% remains sustainable for now.
And looking ahead in the corporate calendar, we expect AGM updates from Deterra Royalties, Endeavour Group, Spark New Zealand and AUB Group. And also Macquarie is expected to release its interim result at the end of the week. And fresh off the press, ResMed released their quarterly result this morning, and Jason Yin, our analyst, has provided his views on the underlying quality of that result.
In Under the Microscope this week, we take a look at borderline Star Growth Stock, Lynas Rare Earths. The code is LYC. Similar to lithium miners mentioned earlier, the share price has moved lower over the year on the back of weakening rare earth prices. In addition, we've noticed a rise in short interest on the stock as well, above 5%. So, Matt, what is the reason for the increasing negative sentiment among these institutional funds on the stock?
Yeah, it's an interesting one, Kien. And Lynas is going through a period of lower profitability with its return on invested capital expected to fall to single digits this financial year. There are two main reasons for this. The first, as you've mentioned, is due to the softening rare earth price environment and slower than anticipated demand for electric vehicles. But in addition to this, the uncertainty around the company's operational license and environmental concerns in Malaysia has forced the company to undertake significant investment in building a cracking and leaching facility in Western Australia.
Yeah, that's interesting, Matt. The capital needs to be allocated to investments positively. But over the week, though, Lynas did announce that they have received a 2-year extension to their cracking and leaching license in Malaysia. And in return, they've agreed to increase their R&D spend to help reduce the environmental impact of those radioactive waste materials. So what does this do? The extension will reduce production bottlenecks and also allow the business higher capacity to make further investments to improve their production capacity. As a result, analysts are increasing their earnings forecast in financial year 25 by around about 10 to 15%. And this should offset the negative earnings revisions driven by the lower commodity prices over the last 3 months.
Yeah, it's good news in the longer term, isn't it, Kien? And the stock is currently trading at a large discount to valuation, and this discount could look even more attractive over the next few weeks as analysts increase their consensus price targets. And although the stock is very well covered with 12 analysts, we need to be mindful that the valuations and forecasts for this business is reliant on commodity price assumptions, which can change quite rapidly. However, if the forecasts numbers eventuate, then there's a high chance that this stock will be removed from our Star Stock universe.
Yeah, something to be wary there, Matt. But long-term investors with a positive view on rare earths may view the share price weakness as an opportunity. I noticed, Matt, under Golden Rule 3, earnings are expected to recover quite strongly in financial year 25. And this is driven by higher production volumes expected and also a recovery in rare earth prices on the back of the demand for electric vehicles and renewable energy sources such as wind turbines. And with many resources companies reporting their quarterlies in recent weeks, a useful question for investors is, what are the key factors you should look for when considering investing in a resources company?
Yeah, it's $1 million question, isn't it, Kien? Resource stocks are cyclical businesses, meaning that their revenues tend to be tied to the economic and commodity price cycle. And with the global economic cycle in this potential contraction phase, there is significant uncertainty with regards to the outlooks for resources stocks. This is reflected in the large negative earning revisions across many stocks in the space, such as lithium miners. Hence, a useful metric to look at is the 3-month earnings revisions, which captures the recent earnings drivers, including commodity price movements and improvements to production volumes.
That's right, Matt. And given that the resources companies have significant capital expenditure via exploration activities, it is also important to look at their return on invested capital. Investors should also focus on a few key operating metrics, which can help drive that return on invested capital over the long term. And these include understanding the resources grade, mine life, production costs, and also the quality of those assets. In addition, it's also important to assess the geographical exposure. For example, Lynas is exposed to significant regulatory and environmental risks with its leaching and cracking plant in Malaysia. Last but not least, the financial health of the business is crucial to help you avoid those speculative investments, especially in the current market environment with high debt costs and softening commodity prices. The majority of resource companies are speculative exploration companies with no cash flows and rely on capital raisings to survive. So you've got to be very careful here.
Extremely careful, Kien. And at the portfolio level, it is very important you're not overly exposed to this resources theme. This is why investing blindly in Australian ETFs can be high risk during a contraction in the commodity price cycle. And currently, the materials and energy sectors comprise some 28% of the All Ordinaries Index benchmark.
Well, that's almost a third of the benchmark, Matt, there. So again, diversification is so important. But that's all we have time for today. Thanks, Matt, for your insights. It's been very valuable, and thanks for your time.
My pleasure, Kien. Thanks for having me.
And for those who have any questions on today's episode or stocks in general, please come along to our Lincoln Live webinar on Monday. But to summarize today's episode, rising interest rates have led to indiscriminate selling of quality and growth and income stocks. So focus on those fundamentals of the business and take advantage of volatility to look for those opportunities. And of course, those resource stocks are prone to significant earnings uncertainty. So it's important to focus on the facts, the underlying qualities of that business. Take care and have a happy, healthy, and prosperous week, everyone.